What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be covering in this update is a brief or text short interest and utilization update to see where we are at the current time with those two really key metrics. We're also going to be going over exactly what is going on with AMC and the broad market today. Now, we've been calling this out over the last week that Thursday and Friday of this week, due to the Jackson Hole Symposium, could lead to a lot of volatility in the broad market, and that was most likely going to affect AMC. We did have another unrelated situation kind of come into play this morning that was kind of pushing down the market due to some bad news that we were receiving, but again, nothing really changes. The shorts have not covered in a substantial way, and we are still pushing along looking for this big price run up over the next couple of weeks. Now, the main thing that I really want to get across to everybody in this video is that there is a really big problem that these big hedge funds, no matter if they're short on AMC or not, that they are facing at the current time. We're going to go over the scale of this issue that they have coming up over the next couple of weeks and how this could potentially affect the market if this situation really starts to play out and how it would benefit us. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And the more people that we have staying up to date on accurate AMC information, the stronger our community becomes. And if you want to see more videos like this, make sure you hit that subscribe button. So at the current time that I'm recording, AMC's trading down about 3.5% at $42.40. So it is entirely possible that we are going to see a big rip up towards the end of today. But again, we are seeing those broad market economic indicators that we were looking for start to play into effect. And those are the updates coming from the Jackson Hole Symposium. We did see that the Fed could be potentially looking at tapering their asset purchases in the near future. So that is not necessarily good in the short term for US equities, because if they are not going to be pumping in that buying demand for a lot of these different bonds or even ETFs, we could see the markets start to take a little bit of a breather just due to the decrease in the demand for these types of assets. And that's why we could potentially see the market sell off and bring AMC with it. Now, when we come over to this Ortex update, this utilization at the current time is still pushing up to that 91% range. Again, we are not really close to that forced share recall territory where we would need to get up to 98, 99, or 100%. But again, with more shares being out on loan, it is entirely possible that the prime brokerage operations are seeing the amount of leverage levels that their clients have and are getting very worried, especially with the short interest being as high as it is, 17.19% at the current time. Now, when we take a look at the options for this week, a lot of people are looking for a big gamma squeeze. Right now, we have 84,000 contracts that are in the money, and I would say that the gamma squeeze that everybody is looking for most likely has already happened with the contracts that are already in the money. So we saw that big 20% day 2 days ago. We shot through that $40 mark, and when we come over to AMC's option chain right here, we can see that this $40 strike has 22,000 contracts for its open interest. Now, if we were to actually have to see another big wave of buying from these institutions to force another price run up, we would need to get above 45, 46, and even $50 a share for us to see that. Now, this also brings up the concept of unhedging. We saw AMC cross above 48, so we did see all of these contracts here go in the money, but now they are out of the money. So if these contracts were already hedged by buying shares, what these market makers or institutions could have done over the last 2 days is sold off those shares, unhedging that directionally neutral position for where the stock was, and that feeds into the decrease in the price that we have been seeing over the last 2 days. Now, let's get into this really big problem that a lot of these over-leveraged hedge funds are facing at the current time. So what we have to go back to really understand what's going on is what happened with Archegos and their total return swap positions. At the end of March 2021, Archegos capital management collapsed under the weight of bets it placed using total return swaps that went wrong. Their excessive leverage on TRS, total return swaps, accompanied by shortcomings in risk management, meant that when it went down, it inflicted billions billions of dollars in losses on the banks that lent it the money to trade those total return swaps. So what we can see here in Archegos' case, it used multiple prime brokers and was able to take advantage of this increase in its funding. The net result was a highly leveraged trading firm whose overall credit risk no one seemed to be monitoring. Archegos used all of this credit to build up huge total return swap positions on a variety of corporations. When prices on these shares started to fall, the prime brokers did what they were supposed to do. They sold the collateral, i.e. they sold the shares that Archegos pledged for the total return swaps. And as anyone who's traded on leverage will know, when you're that highly leveraged, the price falls don't need to be that big to erode your capital. So here's essentially what's going on here. Archegos used these total return swaps. They leveraged up, the positions went against them, and they basically blew out their hedge fund. Archegos most likely is not the only institution who has entered into these really risky bets with these total return swaps and a lot of these other different banks. They were just the first ones to really get caught. So what is a total return swap? Well, a total return swap is an OTC contract or an over-the-counter derivative, something that we have been talking about over the last couple of weeks. And there are a wide variety of OTC derivatives. But with the leverage levels that you can get on these specific total return swaps, and we have that uncleared margin rule, which we're going to go over a little bit more in depth later in this video, coming into effect on September 1st, this is a really big problem that these institutions are facing, and they're going to have to find a way out of it, or they are going to get drained of a significant portion of their liquidity and even potentially face bankruptcy. Now, here's where this gets even more interesting. When we come down here, we can see that total return swaps are contracts used for funding. A financial institution then that is looking to fund some of its assets on its balance sheet could use a total return swap instead of a repo transaction. But what we have to look at here is when we come over to this page, when we look right here, we're going to see UMR's requirements for posting initial and variation margin and mandatory central clearing of OTC derivatives are raising margin call volume and the amount of collateral required substantially. Furthermore, UMR mandates that initial margin be posted by both counterparties to each other, and this two-way margining will be held in a segregated account, meaning that what we are seeing before over here, a financial institution that is looking to fund some of its assets could use some of this collateral to fund some of its other positions. That's not going to be available anymore. So this is going to put a lot more pressure on these institutions, more than we have seen up to date. Now, when we come over to this screenshot right here, ISDA estimates that more than 300 counterparties with an excess of 3,600 relationships may become subject to the regulatory initial margin requirements in Phase 5. That is a lot of institutions. This just kind of goes and shows us the scale of this situation that we are dealing with at the current time and the problem that these institutions are facing. More than 1,000 of those relationships may need to exchange initial margin in the near term following September 1st, and therefore should actively be preparing at this stage. If this doesn't tell you that we have something potentially coming in the near future, not necessarily relating to the AMC short squeeze and forcing these shorts to cover, but with the overall market and how this liquidity is going to be sucked out and these institutions are not going to be able to lever up as much, it looks like something could really be brewing here, and it goes along with everything that we have been saying in my videos over the last couple of months. Now, we also see the margin debt starting to decrease. We went over this in the live stream last night, but when the margin debt starts to peak and then come down, that typically leads a market correction or some sort of market event, because what you're seeing is that people are no longer taking out leveraged positions or not taking out as many levered positions or even closing a lot of these positions. Either way, that would suggest less demand and more selling pressure that could potentially cause the market to come down. Now, circling back around to what we have going on with AMC today and through the end of this week, this price movement to the downside is nothing to be that worried about. 2 days ago, we saw a giant 20% move to the upside, and it is healthy to have these types of small pullbacks. The last couple of really big run-ups that we saw for AMC had one of those significant green days, a little period of consolidation or a sell-off, and then we really went to the upside. So I'm not saying that it is very plausible that we are going to rocket up to new all-time highs over the next couple of weeks, but it is always possible due to the technical patterns that a lot of people such as Astro and a couple of other technical traders have been pointing out. So that is going to wrap up this update on AMC. If you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great day, and I'll see you guys in the next video.